Hi there, in this country focus video we're going to take a look at the Baltic state of Estonia. Now Estonia joined the European Union in 2004 and I've chosen it for a country focus because I think it's a good example of a country that has adopted a broadly defined free market approach to economic growth and development. So here's an aerial view of the Estonian flag waving on the Tal Herman Tower in the beautiful city of Estonia, which is Estonia's capital city. Now Estonia has a small population, just 1.3 million, with a life expectancy of 78 years. And their GDP per capita is about $28,000, so it's risen above middle income. And it has a pretty good HDR ranking. It's 31st on the latest ranking on human development, and critically also 22nd in the World Economic Forum's rankings of competitiveness. So in many ways this is a small economy, a tiny economy, in relative terms, that punches well above its weight. As you'd expect, as a Baltic state, most of their trade, their main export partners are fellow Baltic states, Latvia, Lithuania, along with Finland and Sweden. Of course, Russia is a major trade partner, and that's obviously been affected by the Russian invasion of Ukraine. So a little bit about Estonia before we look at the free market approach and the flat tax system. So Estonia has been inside the EU now for nearly 20 years. It joined in May 2004, and critically, it's also taken the next stage. It's joined the single market and it's joined the European Union Monetary Union. So it has the euro as its currency. It's a very small economy. Their GDP is barely under $30 billion, 30 billion euros, so in 2020. Their economy picked up in 2021 by nearly 6%. Of course, that was the rebound following a fall of 3% during the first wave of COVID. But it's a very small economy. It's also an open economy. 2020 exports of goods and services, just exports, accounted for 86% of Estonia's GDP. So their trade is a big part of their growth and development approach. They also have quite a diverse economy. So they have, for a small population, they've got some significant manufacturing, a lot of ICT. You associate Estonia with lots of digital businesses, logistics, and of course, tourism. And I think in terms of its placing globally, it's consistently ranked as one of the most business-friendly countries in the world, with a favourable tax system and a high level of digitalisation, especially in government. Estonia is known for its innovative approach to technology. There are a lot of startups, a lot of technology companies. E-government has taken a really key place in the way in which the Estonians deliver their public services. Unemployment, while it's risen and fallen as you'd expect, it went up to about 15% after the global financial crisis, but has been on a downward trend since and is around 5.5% of the labour force. But critically, of course, youth unemployment, as in many countries, is much higher. Youth unemployment was above 30% after the global financial crisis. It has come down since, went up during the pandemic, and is now about 17%. So you have a rate of youth unemployment 3 times the overall rate of unemployment. And that's one factor behind the brain drain and net outward migration from Estonia, which is a major supply-side challenge for their economy. Now, Estonia has adopted, this is one of the reasons I've chosen this as a little country focus for you, a free market approach to economic growth and development, particularly in the wake of regaining independence from the Soviet Union in 1991. So the economy has implemented a range of, if you like, market-orientated or free market reforms, supply-side reforms. And as a result of these, Estonia has become one of the most economically liberal countries in Europe. What are these aspects? So many countries adopted this approach to growth. So what are the constituent parts? Well, first of all, privatization. So we'll give you some examples in a second, but there's been quite widespread privatization within Estonia, both transfer of ownership from state to private, as well as opening up industries to competition to make them more contestable. And of course, the main aim of this is to try and drive improved allocative and productive efficiency and to lift labour productivity. So privatisation has gone hand in glove with liberalisation. As you know, Estonia has joined the European Union, so joined a customs union and a single market. They've tried to bring down barriers to entry in many industries, again to promote increased competition and drive dynamic efficiency. Critically, Estonia has a very interesting fiscal policy. They have quite strict fiscal policies. They are required to maintain a balanced budget over the course of an economic cycle. Now, that's something other Western countries in particular struggle to do in recent times. So you would associate Estonia with quite strict fiscal policies, which has left it with a low level of national debt. And one interesting aspect of Estonia, definitely worth knowing, is that they've implemented a flat tax system, which I'll take you through in a second, which has helped to simplify the tax code, if you like, the whole booklets of tax rates and tax allowances facing businesses and households, and cut the cost of running the tax system. Now, the kind of free market approach is not unique to Estonia, but I think Estonia is a good example of a country, a small country within the European Union, which has adopted a pretty pro-market approach, trying to make it easier to do business, in part to attract lots of foreign investment. They are now 7th, according to the Heritage Foundation Index of Economic Freedom in the world, for economic liberalism. I said I'd just give you a little bit more detail on privatization. Privatization, the transfer of ownership from state to private sector, that's been a key part of Estonia's transition from a socialist economy to a market-orientated economy. And still a mixed economy, but much more market-orientated. Banking sector. Estonia privatised their banks, which had been heavily controlled in the Soviet Union. So a good example would be Swedbank. We'll talk about that in a second. In telecoms, Estonia privatised the telecoms company, SD Telecom, which eventually was bought up by a Swedish company, part of the Telia company. Oh, there's Swedbank. So I should have mentioned that. So this is a big financial services company in Estonia, offering commercial banking, insurance, investment services to corporates and households. So Swedbank is one of Estonia's emerging businesses, a privatised bank. The oil shale industry was privatised in the 1990s. So the 1990s was clearly a decade when Estonia made quite big, significant jumps. The transition from state to private, ahead of joining the European Union. And also the energy sector, including electricity and distribution companies. So in banking, in telecoms, in oil shale and in energy, there was significant privatisation in Estonia. And it's a good example of a country that's done this. I said I'd just say a little bit about their flat tax system. So again, they're not the only country to have a flat tax system, but Estonia is a really good example for your notes. They have a flat tax system with a rate of about 20%. So personal income tax is flat, 20%. There's no degree of progressivity. They don't pay 40% on high incomes and 50% and so on. It's 20%. The corporation tax rate is also 20% for profits earned by companies operating within Estonia. Social security, well, that's 33% of salary, but 20% is paid by the employer, 13% by the employee. That will be equivalent of national insurance in the UK. So it's a good example here of a flat tax system. Now, I'll leave you to think about what are the advantages and some of the drawbacks of this, particularly in terms of inequality, incentives, work, leisure, decisions, all that kind of stuff. It's an interesting discussion to have. National debt, of course, is the accumulated government debt of a country yet to be repaid. And it's typically measured as a percentage of a country's GDP. And this chart shows Estonia's national debt. And whilst it's gone up, as it clearly went up during the pandemic, it had to. GDP fell, of course, and governments had to provide emergency fiscal support. You can see that national debt remains very low. And there are quite a few factors that have contributed to this relatively low national debt. First of all, the balanced budget requirement is part of the Estonian constitution. So apparently they're not allowed to run a fiscal deficit for longer than 3 consecutive years. They must balance their budget over the economic cycle. So if you can control your fiscal deficit, by definition, of course, that should control your debt. Allied to point 2, that Estonia has experienced fairly strong growth. It's been one of the success stories in the European Union. And of course, if GDP goes up, your debt as a share of GDP can be controlled. And the Estonian government has a fairly low state sector, a fairly small government, limited government spending, low tax burden. The government doesn't have hugely extensive welfare states or other commitments. Privatisation has helped in that process. So Estonia, I think, a really good example, just to have in your notes, of a country that has adopted a broadly free market approach. And it's widely seen as a success story. Lots of teething problems in the early 1990s, and again when they joined the European Union. They've had to weather the vicissitudes of the global financial crisis. More recently, of course, the fragility created by the events in Ukraine. But I think widely regarded as a success story of one of the new European Union member nations. That said, there are some deep-rooted, embedded supply-side structural problems. Inequality of wealth and income remains high, in part, of course, the result of the flat tax system, which can create a winner-takes-it-all society. There's a regional aspect. Although it's a small economy, the vast majority of growth and development is concentrated in the capital city in Tallinn. Estonia, along with many other Baltic states, including Latvia and Lithuania, has an ageing population and net population loss, net outward migration. And that can lead to labour shortages and a loss of human capital, consequence for long and aggregate supply. And because basically a lot of highly skilled workers are leaving Estonia because they're looking for better opportunities elsewhere. And because they're open to trade, high export to GDP ratio, that does make them vulnerable to economic shocks, external shocks, affecting, for example, the European Union or affecting the global economy. That's always a danger, a risk of becoming a highly open economy. Either way, I hope you found this little look at Estonia useful. You've taken 2 or 3 examples for your notes, perhaps for application. Application really does matter in an exam. And I'll be doing more country focuses, country profiles in the weeks to come. This was a country focus on Estonia. If you liked it, please press like, maybe consider subscribing. But most of all, stay happy, stay healthy, stay positive, stay curious, and see you sometime soon.